A recent shift in where investors are buying stock may be a sign that change is coming to the market and the economy. Thanks for joining us for this week's Fastest 4 Minutes in Finance. I'm Scott Inman. Well, we are firmly into fall and football season. And if you're a fan like me, you love it when your favorite team has the ball, right? Because when the offense is on the field, you're more confident that your team is going to score. The defense does score occasionally, but not nearly as often. Well, sometimes in investing, the defense can score more than the offense. Our partners at LPL Research posted an interesting article on their blog last week titled "Defense Takes the Field." According to LPL, over the past few weeks, capital has flowed out of technology and other cyclical areas that are associated with growth and moved into more defensive sectors. Now, defensive sectors are comprised of companies that are expected to hold up better if the economy slows down or enters a recession. Three big ones are consumer staples, because people still have to buy necessities, utilities, because we still have to keep the lights and heat on, and healthcare, because we keep going to the doctor even when money is tight. Take a look at these charts. Now, they're meant to compare the relative strength of those three defensive sectors to the S&P 500 index. If you follow the black line, you will see upswings and downswings, which are representative of when these sectors are outperforming or underperforming the broader market. If you notice in the middle of the charts, a dotted gray line goes all the way through. That is the last time those defensive sectors entered an upswing, and it was early 2022 when the broader market entered a bear market. Now, at the far right, you can see we just entered another upswing. Now, that's not to say we're about to enter another bear market or even a recession, but as LPL points out, it does show investors are losing their appetite for risk and rotating to more recession-proof or less volatile areas of the market. Now, let's take a look at one more chart. This shows the performance of a hypothetical $100,000 investment in 1994 in three strategies. The orange line is simply the S&P 500 index. The black line is a defensive basket defined as the consumer, staples, healthcare, and utility sectors. And the blue line is a rotation between the two, based on when the defensive basket was in an uptrend or a downtrend. You can see this sector rotation would have paid off big time. This makes the case that active management in your portfolio can be beneficial. Of course, this material is for general information only and not intended to provide specific investment advice. To determine which investments may be appropriate for you, you should work with a financial advisor. LPL Research does not believe that the recent shift to defense is a big threat to the longer-term bull market, but it does suggest a bumpier ride in the next few months and that sometimes the best offense is a good defense. Thanks for watching. Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.